Do-it-yourself investors are people who've decided that they have the time, the interest, and the energy to manage their portfolio by themselves. And they typically are people who question the value of advice and paying for advice and want to figure it out on their own. What most of them do is they invest using a discount brokerage or an online brokerage account. Popular ones like Questrade, Qtrade, or the bank brokerage based platforms all make it possible for investors to manage on their own. A critical piece compared to full service brokerages, though, discount brokerages by law cannot give recommendations or information to clients to steer them to a particular investment choice. So investors have to rely on themselves, their own research, and their own ideas to come up with a plan. For about 40 years, Environics has been measuring the hearts and the mindsets of Canadians through our social values research program. In addition to looking at how countries or populations are shifting in their values year over year, we can also use this data to look at different subsegments of the population. So for this analysis, we looked at the social values of those who own a discount brokerage account in addition to the regular research metrics like demographics and asset sizes and so on. And this gives us unique insights into what motivates them, why they're do-it-yourself investors, what they're trying to achieve, and how this is consistent with their overall self-claimed risk assessment and financial engagement. Do-it-yourself investors score very highly on values related to personal control, the need for autonomy, the willingness to take on higher levels of risk, and I would say a sense of great confidence and optimism, particularly during growth periods. Do-it-yourself investors do tend to be more male than female. Our latest research shows about 2/3 of them are men. And they tend to be in the middle years. They're not young, they're not old, they're in the mid years, sort of late 30s into the 40s, maybe 50s. And they tend to be very well educated and have investment portfolios that are actually larger, given their age, than all Canadian investors do. And this is because they score very high on a value called saving on principle. It's really important for them to take control of their finances, grow their wealth, and they're motivated when they eventually pass on to share that with their children or maybe to charity. They score high on a trend called legacy, which is all about passing on that wealth to the next generation. So their values are actually what make them do-it-yourself investors. In the current crisis, most investors have stayed pat. We see about 50 or 60% of all Canadians who have assets are working with an advisor. And those advisors tell us that most of their clients called them or were concerned, raised the question, should they sell? And the advisor said, no, stick to your plan. Nothing has fundamentally changed in your need for risk or your appetite for risk. What has changed is the normal market volatility, and we've built your plan around that. And most investors are quite satisfied with that. However, very recent research that we did in the midst of the crisis showed that about 4% of investors sold their investments or some of their investments specifically to minimize further loss. So they were spooked by the market declines and decided to sell out to avoid further erosion. We also found that another 8% moved cash from the sidelines into the markets, thinking that they were buying at an ideal entry point. Both of these groups were motivated by, again, the strong need for personal control, desire to save and grow wealth. But the people who sold have values that show much greater fear, impulsivity, and concerns about whether they were really making the right financial decisions. Whereas the people who move from cash into the markets tend to be a bit younger, more optimistic, more idealistic, and a much greater sense of risk appetite. And so the mindset about someone who's either going to exit during a crisis or someone who's going to enter during a crisis reflects their personal values and their own strategies to investing, but that doesn't necessarily guarantee a positive outcome.